Today we're looking at the company B2Gold. It trades on the New York Stock Exchange under the ticker BTG. It closed today at $2.54, and this company is the biggest dividend payer in the entire gold space with a dividend yield of 6.37%. Today we're going to do a deep dive into the company to see how safe this dividend is and if it could potentially be increased in the coming quarters or coming years. And also, we're going to look into their cash flows. We're going to look into how safe the investment is and where could the company be trading at in a year, 2 years, or 3 years. So let's get right into it. As always, this is just my analysis based on my own research, and you should always do lots of your own research before investing any of your money. I'd like to start out by mentioning some things that I really like about the company. First off, the company has no debt at all, plus they have a $700 million totally undrawn credit facility that they can access if they need it. Plus, they have over $300 million in cash. Next is the big dividend that they pay, and also they have significant growth coming in the next couple of years. So in 2025, we should see about an additional 350,000 ounces of production coming from increased production at their moly mine. And also in 2025, they're going to be starting production at their new Goose mine that they're currently building in Canada. In addition to those things, the management team is one of the best in the industry. They have a long history of under-promising and over-delivering, building mines on time and on budget. Actually, most of their mine builds have been completed early. And also, they're really good at working with governments in places that are generally considered to be difficult places to operate. Really, really great management team. Something else I like is that they're a low-cost producer. B2Gold has one of the lowest cash costs for their mined gold in the entire industry, which makes them able to pay a really high dividend. Another thing I like about the company is that they currently have 3 operating mines, and they're going to be adding a 4th in about a year. So you have some diversification right now if something were to happen to one of those mines, and pretty soon there's going to be even more diversification. And speaking of diversification, the 4th mine that they're adding is in Canada, which improves their political risk profile dramatically. So when you improve your political risk profile, you should also improve the multiple that you're getting by the market. So I think this will help the company be valued at a higher level. Another thing I like about them is they have big gold reserves and resources, so their average mine is going to be operating for many years into the future, which gives a certain certainty to cash flow in the future. And their Goose mine that they're currently building in Nunavut, this Goose mine, although it's going to be producing 300,000 ounces a year to start out, I think this has potential to be expanded and perhaps have the opportunity to be in excess of a 500,000 ounce producer in the future with a very long mine life. And before we analyze the financials of the company, I want to talk about some risks that the company faces as well. The first risk is that a big percentage of the company's production is coming from a pretty unstable political jurisdiction, Mali. And secondly, they're a gold miner, so they operate in a risky business to begin with. Another risk they face is they've seen some increasing costs, actually significantly increasing costs, which might eat into their margins if we don't continue to see higher gold prices. But in fairness, these things apply to every gold producer. Another risk is that the company is guiding for a decreased production profile in 2024. Now it's going to go back up again in 2025, but the market does not like to see years of decreasing production or years of decreasing revenue. So that could be something that holds the stock back this year. And the company's biggest risk is their Goose mine. So are they going to be able to build this mine on time and on budget? We've already seen some cost overruns, so are there going to be more cost overruns? Now in the past, they've built mines on time, actually early, but will that be the case here? They're building this way up north in the Arctic. It's a very unfriendly place in terms of the weather. So how many problems will they face there? We don't know. And also, after they get it built, will they be able to ramp up production in a reasonable amount of time and get that operating at nameplate capacity at costs that are in line with what investors are expecting? That is the single biggest risk that B2Gold faces. But with that said, if anybody in this industry can do that reliably, it's Clive Johnson and his team at B2Gold. They've built a lot of mines over the course of their careers, and they've been very successful in doing so. The company's guidance for their 2024 production is between 860,000 ounces to 940,000 ounces at an all-in sustaining cost between $1,360 to $1,420 per ounce. But something that this management team is very, very good at is under-promising and over-delivering. They almost always beat their midpoint of guidance. So for this analysis, I'm going to assume production of 920,000 ounces a year, which is close to their top end of guidance. And then I'm going to assume an all-in sustaining cost of $1,380 per ounce, because that's towards the low end of their guidance for cost. And since they have a history of over-delivering, well, I think it's safe to assume that they do that again in 2024. And in this guidance, they're assuming that they do not get a permit in 2024 from the government of Mali to truck ore from their satellite deposits to their mill. But there is the real possibility of them getting that permit in 2024 so they can start trucking that ore in to increase their production in Mali. And that's not in the guidance at all. If that permit comes sooner, they could exceed the top end of this guidance. And if they exceed the top end of the guidance for ounces, they're probably also going to exceed the lower end of the guidance for costs. Because as you produce more ounces, your cost per unit comes down. So as you're following B2Gold this year, be sure to keep an eye out on their press releases in case they get that permit from the Mali government to truck ore to their Fekola mill. Because if they get that permit early, well, that means an increase in production. For a couple of years now, the company has been paying a 16 cents USD per share dividend per year. And in order to continue paying this dividend at this level, they're going to need $208 million. But also this year, they have to finish construction of the Goose mine. And to do so, they're going to need $335 million. So between these two things, they're going to need over $540 million in cash this year. So now let's look at their cash flows to see if they're going to have enough money to pay this dividend and pay these CapEx costs for Goose. It looks like they're going to be producing about 920,000 ounces of gold at an all-in sustaining cost of $1,380 per ounce. Over here on the left-hand column, I have what the average gold price might be for 2024. On the low end, I have $2,000. In the middle, I have $2,200, which is about today's gold price. And then at the high end, $2,400 an ounce. So if gold goes way down, and the average price of gold in 2024 is $2,000 an ounce, the company will have cash from operations after taking into account the all-in sustaining costs of $570 million. Now, of course, the gold price could go below $2,000 an ounce, but it would have to go down quite a bit to be there. But in this scenario, even in worst case, we have $570 million in cash from operations. If the gold price averages about what it is today, well, then the company will be bringing in $754 million from operations, or at $2,400 gold, we're looking at $938 million. In 2024, the big Fekola mine is mining lower grades, so that means costs are going to be higher and production is going to be lower. But in 2025, that's going to be the Goose mine's first year of production, and they're going to be producing over 200,000 ounces of gold from that. But in addition to that, a lot of major capital expenditures in addition to the Goose mine are ending in 2024. So in 2025, costs should drop a lot. And the Fekola mine in Mali is going to be mining much higher grades in 2025 than it is this year, which will bring production up and will bring costs down. So in 2025, we're looking at production of about 1.2 million ounces at an all-in sustaining cost of about $1,200 an ounce. But there's this gold prepay arrangement. In January of this year, B2Gold entered into this arrangement where they would receive $500 million up front, but then between July 2025, so this year, and June 2026, each month they would be delivering an equal amount of gold to those people who gave them that $500 million. And they're going to have to deliver about 264,000 ounces. So in 2025, that liability is going to be $290 million. So yes, there's going to be higher production. Yes, there's going to be lower costs, but you also have to offset that with this gold prepay. In 2025, after taking into account the gold prepay, on the low end, we're looking at cash from operations of about $700 million, and at the high end, cash from operations of about $1.2 billion. And remember, we don't have the big capital expenditures from Goose happening in 2025 either. So we're going to have a lot of extra cash. And remember, there's no debt to pay off at all. So that's going to leave a lot of extra money to either raise the dividend or buy back shares. And then we have 2026. The first 2 quarters of 2026 are probably going to look a lot like 2025 because they still have that gold prepay obligation. But after we hit quarter 3, 2026, it changes a lot because we no longer have this $290 million gold prepay obligation. So I think after the financials come in for quarter 3 of 2026, which I believe is going to be in November of 2026 that we would get that information, the quarterly earnings are going to be off the charts. They're going to be crazy good. 2026 is going to be the first full year of production from Goose, so we should be getting about 300,000 ounces from that mine. But I'm taking these numbers starting in quarter 3 of 2026 and annualizing it, because that's what investors are going to do when they see those quarter 3 2026 numbers and this gold prepay is done. They're going to be annualizing that to see how much money B2Gold is going to be making. And if we have a gold price of $2,000 an ounce, B2Gold is going to have cash from operations of nearly $1 billion. And at $2,400 gold, we're looking at nearly $1.5 billion. So if this is what the cash flow looks like around the end of 2026, and if you bought the stock today with a dividend yield of about 6.3, 6.4%, I could see the dividend tripling from here. Or in other words, your dividend yield based on your purchase price would be almost 20% a year if their cash flow is going to look something like this and they have no debt whatsoever. And just to quickly recap the expenses we were talking about earlier, the company is going to need $335 million to finish building the Goose mine and $208 million as a dividend payment to maintain the same dividend level for a total of $543 million. Now the company has other expenses too, like G&A and stuff, but let's see what it looks like relative to how much cash they have, how much money they have coming in this year, and how much they're going to have to spend. So right now they have $307 million in cash. 2024 cash from operations, based on the analysis from earlier, should be somewhere between $570 million to $938 million, which puts the 2024 year-end cash before expenses at $877 million on the low end to $1.245 billion on the high end. So clearly, this is more than enough to cover this $543 million here. And now let's look at some of the reasons why the stock price is so low despite gold hitting all-time nominal highs. Number 1 is political risk. A significant portion of their production comes from Mali, and a lot of investors are scared of Mali. But you know what? With their Goose mine in Canada, this political risk profile is going to be much improved. Second is Mali changing their mining code. B2Gold's Fekola mine is grandfathered into the old code in 2012. However, Mali just changed their new code effective in 2023, and under that, Mali's percentage of ownership of the mines goes from 20% to 35%. So B2Gold took a $200 million write-down on some of their Mali development assets. They say that they're working with the government to try to get that mining code changed, and it sounds like there's some progress being made, and what they did have as the 2023 mining code is not going to be the final mining code, so we'll see how that works out. But the good news is that the Fekola mine is grandfathered in under the old mining code, in which B2Gold gets to keep a lot more of the profits. I think the absolute biggest thing depressing B2Gold's stock price right now is just poor market sentiment. Despite gold being at all-time highs, the sentiment is horrible. I think it's getting a little bit better, but it's still really, really bad, and I think that's the biggest factor depressing the stock price. Another reason is the delay in getting the permit to be able to truck the ore from the satellite deposits to the Fekola mill. And the delay seems to be caused by the change in the mining code, but they should be getting that before too long. In their guidance, they're not planning on getting that in 2024, although I suspect they're being very conservative with that estimate. Something else affecting the stock price is the cost overruns at Goose. A little while back, B2Gold announced that, hey, we thought it was going to cost us this much to build it, but actually we've made some changes and inflation is higher than we thought, so it's going to cost us this much. And they raised the cost of it by something like $400 million. But now after they revise that cost, I don't think we're going to go any higher than this in terms of the cost to build Goose, because they've already reduced the risk by quite a bit by buying all the big ticket items. And also, they're really good mine builders who have a history of building on time and on budget. This Goose mine was a little bit different because they bought a company who had already started building the mine. Normally, they would buy it while it's still in development before the company starts building, and then B2Gold designs the mine exactly how they want it. But in this case, they came in later in the process, so they were doing something a bit different than what they've been successful doing in the past. Another thing depressing the stock price is that the market seems to only be valuing current cash flows, and they hate growth projects right now. The market is punishing any company who's investing in growth, which personally I think is a little bit ridiculous, because you have to invest in growth in a business like this where your assets are constantly depleting. Now, the companies get rewarded for this after the mine is finished being built and it's running at full capacity. But until then, any company that's building a new mine, their stock price is getting punished like crazy. And now I would like to quickly cover some of the company's assets aside from their operating mines. First are their gold reserves and resources. So here I'm counting proven and probable and measured and indicated. So I'm excluding inferred resources. So these are only the highest confidence categories, from which they have 29.6 million ounces. However, when you're mining, you don't recover everything. So they have about a 91% recovery rate. So after taking into account that 91%, we're looking at 26.9 million ounces of gold in the ground that are going to be recovered. In addition to those gold resources, the company owns 9.9% of the shares of Snowline Gold, currently valued at $63 million. They have this Helmi discovery in Finland that I think they could sell for north of $100 million. It's right next to this other company's discovery, and this other company is probably going to want that. So that's a very marketable discovery in the case that B2Gold decides not to develop it in the future. And then you have their Gramalote project in Colombia, which B2Gold recently bought the other 50% of, and I think the value of that is somewhere around $150 million. And then you have the Hackett River silver royalty, which I think B2Gold could sell for $70 million. So from these assets, we have about $383 million. And now let's talk about valuation. The company is currently trading at $2.54, putting the market cap at $3.3 billion, but the company has $307 million of cash. So after taking into account the cash, that's what the market is valuing the company at today, $2.93 billion. Before getting into valuations, we have to think about some things to determine what kind of multiplier this company deserves. First of all, they have a proven management team. They've been very, very good for several decades. Really great mine builders, really great operators, great at working in hard to operate jurisdictions. They're building this Goose mine, and they've built a mine in the Arctic before, like the Goose mine is. They have big gold reserves. They have an improving political risk profile with their new mine in Canada that's being built. They have no debt, which is big, and they have huge exploration upside at Goose. They are going to find so many more ounces there. So they're going to grow those reserves a lot at Goose. So I think eventually they're going to expand that mine, and maybe that's a 500,000 ounce producer per year in the future. And speaking of Goose, the construction is de-risked because they've already purchased a lot of the big ticket items. They've already ordered those things. And then in addition to that, additional growth is likely with Gramalote in Colombia. So you have a lot of positives going for this company. Because of all of these things, I think the multiplier that they deserve is somewhere between 8 and 10 times cash flow, plus their cash on hand, minus any debt they might have. So that's the formula I'm going to be using to determine what the stock price might be in the future. I'm going to go over what I see the potential of the stock price being right here. And then after this, I'm going to talk about what my verdict is, whether it's sell, hold, buy, or strong buy, and also what I think the risk level is with this. So I see a few options here. First, you hold the stock until the end of 2024. Well, a little after that, because you have to wait until the earnings come out for the full year of 2024. Based on an 8 times cash flow multiplier, we're looking at $4.87 for the stock price, or at a 10 times cash flow multiplier, we're looking at $6.03. And also, you're probably going to collect 16 cents in dividends while you wait. And if you're a US or Canadian investor, I highly recommend that you opt into the DRIP program, the dividend reinvestment plan, because if you do that, the dividends that are reinvested into shares for you, you get those shares at a discount. It's up to a 5% discount. So that's a great deal. I highly recommend that if you're a US or Canadian investor. So that's holding it until we see the results from the full year of 2024. But I think the longer you hold the stock, the more money you're going to make from it. If you hold it until we see the results of 2025, I think we're looking at a stock price somewhere between about $6 and $7. And in the meantime, you're probably going to collect at least 32 cents in dividends. But by 2025, I think they're going to have enough cash flow and enough extra cash to raise this dividend. So I think it could be this or higher. And then if you hold the stock through the end of 2026, so we see the final year results from 2026, I think we're looking at a stock price somewhere between $7.50 to $9.50. And by the way, all of this is assuming that the gold price stays about where it is today at $2,200 an ounce. So $7.50 to $9.50. Plus, you're probably going to collect at least 48 cents in dividends while you wait. Although I think we could get a double in the stock price in about a year, I'm putting my investment time horizon as 3 years, because with this company, I think the longer we hold it, up to 3 years, the more money we're going to make from this. And also we're going to get paid a very healthy dividend along the way. So my target price is going to be $8.50, which is basically right in the middle of this, so 9 times cash flow, plus the dividends you're going to collect. And I think, as I mentioned earlier, that at today's purchase price, 3 years from now, we could see a dividend yield of close to 20% based on what I think the company's future cash flows will be. As for the risk level, 1 being the least risky, 10 being the most risky, I'm putting this as a 5. It's a proven management team. They have no debt. They have 3 mines that are currently producing, and soon it's going to be a 4th. So they have some diversification, but they're in the gold mining business. It's a risky business because something could happen at one of your mines. You could get one of your mines shut down. You could see cost blowouts. We could see costs go way up. And also they have that mine build in the Arctic. Things could go majorly wrong with that as well. It's certainly not riskless. However, there's much, much riskier options out there. So my verdict, since we could see more than a triple plus very healthy dividends in 3 years, I'm putting this as a strong buy. As a matter of fact, after doing this analysis, this is one of my very top picks that I've seen in the whole industry. So thank you for suggesting that I do an analysis of B2Gold, because I'm very, very happy that I did. And if you have any other suggestions for me, please let me know in the comments below. If you found this video helpful, please subscribe to the channel and check out one of these videos next. and I'll see you over there.